If you are waiting for confirmation, you might already be late. Global funds have started flowing back into equities. Is big money positioning quietly while retail investors hesitate again? That discomfort you are feeling right now, that's the gap between liquidity and headlines. Because markets don't announce when smart money enters, and by the end of this video, you will understand why global inflows matter more than the headlines, how foreign capital silently re-rates the market, whether this move is durable or temporary, and how to position without chasing. Stay with me because liquidity moves or the prices explode. Let's start with a simple truth. Markets are not driven by opinions, they are driven by liquidity. When global equity funds sees inflows, it means capital is returning to risk. Now that capital has to go somewhere. And when it looks at emerging markets like India, it asks questions. Is growth visible? Is currency stable? Is risk manageable? If the answers are acceptable, capital moves. And when the capital moves, valuations adjust before retail even notices. Now, here is where you need to pay attention. Foreign capital does not move emotionally, it moves strategically. When global risk appetite improves, whether due to rate expectations stabilizing, inflation cooling, or geopolitical tension easing, funds rotate back into equity. Now that rotation compresses fear, and compressed fear expands the multiple. But here is the uncomfortable part. Retail usually waits for clarity. By the time clarity appears in headlines, positioning is already underway. Now, pause here, ask yourself honestly, are you reacting to news or reading liquidity? Because if global equity flows persist for weeks, not days, that signals structural appetite returning. If they reverse quickly, that signals tactical bounce. And the difference between tactical and structural matters enormously. Structural inflows create sustained rallies. Tactical inflows create sharp but fragile moves. Now, let's connect this to India specifically. If global funds increase allocation to emerging markets, India often benefits due to growth visibility, demographic advantage, earnings momentum, policy stability. But inflows don't impact all sectors equally. Capital usually flows first into financials, large cap leaders, high liquidity stocks. Then, if the confidence builds, mid caps participate. So, you should watch the leadership because leadership reveals conviction. If banks and heavyweights lead, capital confidence is higher. If narrow themes rally alone, liquidity may be shallow. Now, here is the psychological trap. Retail investors often wait for price confirmation, but by the time breakouts are obvious, early positioning has already occurred. That's why like markets run away from retail. It's not manipulation, it's just timing. Liquidity moves quietly, price follows visibly, and headlines follow last. Now, let's address the risk. What could derail this? If global bond yields spike again, if the dollar strengthens aggressively, and if the geopolitical risk surfaces, risk appetite can reverse. That's why sustainability matters more than excitement. The question is not, are markets going up? The real question is liquidity expanding sustainably? Because expanding liquidity changes the valuation framework. When capital competes for exposure, multiples rise. And capital withdraws, multiples compress. Now that's the mechanism. Now let me bring this back to you. You're constantly waiting for emotional comfort before acting. You will always feel late. But acting without structure is reckless. So, what's the balance? Watch persistence. Watch sector leadership. You should watch the flow continuity. And most importantly, watch your own psychology. If you feel sudden urgency, slow down. If you feel informed and structured, act proportionately. Markets don't reward speed, they reward positioning. And positioning happens before excitement. If you want to understand liquidity before headlines, subscribe. Because most channels explain what happened, focus on what's forming. And that's the difference between reacting and positioning. Thank you.